Afternoon, everyone, and welcome to today's briefing on the Middle East conflict and its impact on the crude, LNG, and container shipping markets. Clearly, these are anxious times for global shipping. Although a unilateral, open-ended ceasefire extension has now been announced by the United States and what would appear to be back-channel diplomatic exchanges between the United States and Iran appear to be ongoing, it's very clear that tensions in the region remain incredibly high. And with peace talks now delayed, there is still no clear timeline for when safe and unrestricted passage through the Strait of Hormuz might resume. My name is James Harley. I'm Head of Marketing and Business Development at Drewry, and I'm delighted to be joined today by Rajesh Verma, Deputy Director of Bulk Shipping Research at Drewry, and Simon Heaney, Senior Manager of Container Shipping Research and Editor of Drewry's flagship Container Forecaster service. We're going to start today's session with brief snapshot situation reports from both Rajesh and Simon. And for each of their respective sectors, they're going to provide key scenario impact assessments associated with either short-term or more prolonged restrictions on transits via Hormuz. So we really want today's session to be as interactive as possible. So please, as usual, submit any questions you may have in the usual way via the Q&A panel that you see on your screen. As always, any questions that we don't have the time in today's session to answer, we'll address those in the post-event review, follow-up communication, which will include a link to the recording of this presentation and PDF of the presentation slides. So without further ado, I'm going to turn the spotlight to Rajesh, who's going to open with his update covering the crude and LNG shipping markets. Over to you, Rajesh.
Thank you, James. Hello, everyone. Welcome, and thank you for joining us at this Drewry webinar. I'm Rajesh Verma, Deputy Director, Bulk Shipping Research at Drewry and editor of Drewry's Crude Tanker Forecaster. So over the next 10-15 minutes, I'll discuss the impact of the Iran war on crude and LNG shipping markets under different scenarios. And I'll also try to cover about what lasting impact it could have. So first, I'll start with the impact of the war on crude tanker market. So as we all know, the Strait of Hormuz is a critical choke point for the global oil and gas supply. So in 2025, about 15 millions of crude oil transited through the Strait of Hormuz, which accounted for roughly 14 millions of global oil demand. As about 5 million of this 15 million volume, overall 15 million volume, can bypass the Strait of Hormuz through the east-west pipeline of Saudi Arabia, Abu Dhabi crude oil pipeline, and small volumes through Kirkuk-Sehan pipeline. There'll be still around 10 millions of oil blocked inside the Hormuz. Now, which is roughly around 10% of global oil demand. Now, if we consider at the start of the year, global oil supply was expected to be 3.6 million barrels per day higher than demand. So that along with some destruction in demand will lead to net 6 million barrels per day of crude shortage. If we again add around 4 million barrels of disruption to refined products flows, the overall oil supply deficit in the market will be around 10% of global demand, and which is very significant. So let's, in terms of the dependency, obviously Asian markets will be the most impacted as they import around 80% of the flows through the Strait of Hormuz. So let's have look at the impact of the ongoing war on the freight rates. So interestingly, despite the disruption of significant volume of crude oil flows through Strait of Hormuz, VLCC TCs, which were already high before the war, surged higher. And this surge was mainly on account of the sudden shift in demand from alternative sources. As tonnage availability on those alternative supply hubs were limited, freight rates surged higher. Although the rates have, or earnings rather, have come down from those peaks to lower levels, they are still way well above the pre-war levels. Now, if we look at the second chart, which shows the forward curve for VLCC TD 2022 route from US to China, we can clearly see that there is a sudden upward shift in forward curve of freight rates on this route. Now, although the overall forward curve has shifted upward, if we can see the latest FFA, it shows that the oil freight rates in the VLCC market will gradually decline over the next 4-5 months, and that signals that market is anticipating a lower demand going forward because of the current blockade. Let's now look at the impact of the current war in different scenarios. As it is very difficult to predict how long this war will last, we have created two scenarios. One, which is base case, short-term disruption until the end of June 2026. And in the more pessimistic scenario, we have considered prolonged disruption lasting for the 12 months, which is until February 2027. Now, in the first scenario, especially in the second quarter, because of tight supply from the Strait of Hormuz, there will be significant surge in oil prices, and which in turn will lead to drawdown in oil inventories. At the same time, there will be some demand destruction, which in turn will hurt the overall crude oil trade. However, once this Strait of Hormuz traffic normalizes in the second half of the year, there'll be a surge in stocking demand, as well as any decline in oil prices will lead to higher consumption that will boost the trade. But overall, in the second quarter itself, when there'll be blockade and global crude oil trade will slump, in that case, there'll be significant decline in freight rates. And we expect that the freight rates to go well below the pre-war levels. However, in the second half, once this Strait of Hormuz traffic improves, we'll see a surge in demand, and which will push the freight rates higher. But it will still remain below pre-war levels because there will be ample supply in the market because of expansion in crude tanker fleet. Now, if we consider the second scenario where the Strait of Hormuz blockade will last for 12 months, it will be a debacle for the global oil supply and global economic activity. Because in such a situation, around 10% of global oil supply will be gone for the one whole complete year. That obviously will push the oil prices to record high levels. There will be significant destruction in demand. At the same time, there will be squeeze on the overall trade. Now, inventory drawdown coupled with the demand destruction lead to squeeze on trade. Overall demand in this scenario, we expect to go down by around 4 million barrels per day, which is very high. Now, freight rates in this scenario, we expect like the freight rates to go down significantly lower than the pre-war levels because of very weak demand. I'll not be surprised if the vessel earnings go down below OPEX levels. So shippers might find it difficult to cover their operating cost in this scenario. Nonetheless, if once the Strait of Hormuz traffic improves, we can see a significant surge in crude oil trade globally, which will in turn support the ton-mile demand for crude tankers, pushing the freight rates higher again. Now let's move to the gas sector. Let's see what are the implications for the LNG market, LNG shipping market. So similar to oil, around 20% of global LNG supply has got trapped inside the Strait of Hormuz because of the current blockade. Uh, although unlike the crude oil, there is no volume, like the entire volume will be trapped inside the Hormuz because of there is no scope to bypass the Hormuz. Additionally, around 17% of Qatar's LNG supply has been wiped out for another maybe 3-5 years. So that disruption will remain even if the Strait of Hormuz opens. So inside the Strait of Hormuz, mainly two main suppliers are there, Qatar and UAE. So this entire volume will be trapped inside the Strait of Hormuz as long as the blockade remains. Now, in terms of the dependency, Asia in particular, similar to oil, will be impacted the most because around 80% of LNG supply from the Gulf moves to Asia. And although like Europe also imports a significant volume from the Middle East, but at least they have some cushion of higher supply, likely higher supply from the US to meet their deficit. Now let's move to the freight rate section where we will see how the current blockade has impacted the freight rates in the LNG shipping market. So if we see the first chart on the left side, similar to oil VLCC earnings here, the freight rates earnings in the LNG market has also shot up, just up immediately after the war. And again, the reason is similar because the demand shifted to alternative locations where there was not enough tonnage supply available, which in turn underpinned the freight rates. Although freight rates and earnings have come down significantly from those peak levels, but they are still more than double than the pre-war levels. If we look at the FFA chart on the right side, we can see a significant upsurge or upward shift in forward demand curve, forward freight curve for the BLNG 3 US to Japan route. Now, if we see the curve, this again shows that in the coming months, the freight rates are expected to come down, but the overall, you can say the forward trajectory is still above the pre-war levels. Now let's move to the Drewry's view on what will happen to the LNG shipping market in two different scenarios. So in the first scenario, which is base case, there will be short-term disruption. Obviously this because there is no major alternative available for the LNG supply from the Middle East. There will be net shortage of supply of LNG, which in turn will keep the demand for LNG shipping weak. And accordingly, we can see a sharp decline in freight rates in the second quarter of the year. However, in this scenario, when we are assuming the Strait of Hormuz will reopen after the first half of the year, LNG supply will take a couple of months to improve because the current supply pipeline will take time to restart. So obviously after a lag of 2 months, maybe we can see a surge in LNG demand and trade. And obviously in such a situation, freight rates will go higher. Now, unlike the VLCC market, here we expect like it will reach towards the pre-war levels. And one of the reasons for this is because of this disruption, there'll be some permanent or if not permanent, medium-term disruption to Qatar LNG supply around 17% of Qatar's LNG supply will remain disrupted for 3 to 5 years. So in such a case, there'll be a likely surge in US exports of LNG to Europe as well as Asia. So that will keep the ton mile demand higher. Although, like, because there will be some volume gone from the Qatar LNG, the any significant surge above pre-war levels is unlikely. However, in the prolonged disruption scenario where LNG supply from the Gulf will be disrupted for the 12 months, there'll be severe supply crunch in the global LNG market. Around 20% of supply will be gone for 12 to survive this deficit. So accordingly, there'll be severe demand destruction from the downstream power generation, even industries for LNG. And that obviously will hurt the overall LNG trade during the year. With the decline in freight rates and tonnage demand, obviously freight rates will also slump. And in this case, again, it will slump well below the pre-war levels because there will be also additional supply coming up in the second half of the year. That, in tandem with weak demand, will lead to a significant decline in freight rates. Nonetheless, if we expect that in this scenario that traffic will resume after February 2027, in that case, after a couple of months lag, maybe the trade will start climbing higher because of, like, once the supply improves, there will be a decline in LNG prices as well, which in turn will lead to increase in stocking demand. So with the increase in stocking demand and consumption demand, your trade from Gulf will surge higher. Nonetheless, like, we cannot forget that this 17% of Qatar LNG capacity will be out of the market for next 3-5 years, which means that even after the normalization of traffic from the Strait of Hormuz, this volume will remain out of the overall global supply. So pre-war volumes will not be reached even after the reopening. So just because of an increased supply and improved demand, we can see recovery in freight rates. But nonetheless, as tonnage supply will also increase over the next 2 years, so that will put a cap on the freight rates to some extent. So that is all from the crude and LNG shipping market. Now I'll hand it over to Simon, who will cover the impact of Iran war on the container shipping market. Over to you, Simon.
Thanks very much, Rajesh. It's really great to get your deeper insight into the energy market, as that's really one of the biggest concerns as far as the container market is concerned. So some of you attending today might have listened to the container-specific webinar that I co-hosted last week, a recording of which you can now find on Drewry's on-demand platform. But for today's multi-sector presentation, I'm going to focus more on the risks and what lasting effects it could have on the sector. But first, I think it's important to put this crisis in perspective as it relates to containers. So it is serious, but not pandemic scale serious. So operationally, this is a relatively small and localized disruption for container shipping lines. I mean, the Middle East accounts for under 5% of global container port throughput, which compares to 55% if you're looking at the Far East as a block. Now, direct services to the Gulf were very quickly replaced with multimodal land bridge solutions that were quickly set up to ensure that critical supplies, particularly food imports, could flow into the region. So the situation is now that shipping to and from the Gulf is now much more complex and circuitous and much more expensive. But elsewhere, outside of the Middle East, the liner services have largely remained as they were. But what is not a local problem is inflation of freight transportation costs. Higher bunker prices are up between 60 to 80% since the start of the conflict. They have spread to every trade route around the world, not just again the Middle East. And so distance from the firing line does not shield ship owners, operators, and cargo owners from higher costs. Now, this chart comes from our on-demand platform, now open to the container sector. It was already available for other shipping sectors, and this sort of demonstrates the dramatic price surge that we've seen recently to bunkers. Now, disruption is generally perceived as being supportive to carriers' bottom line, but this crisis is different from the COVID period. Back then, freight rates and carrier profits soared to heights we've never ever seen before, and I don't think we'll see again. And that was because you had a toxic mix of severe supply constraints at every link of the supply chain, from not only outside of port, import, trucking, warehousing, you name it. And that was at pretty much a global level too. And that coincided with a surge in demand for containerized goods. This conflict is different in the sense that it will, yes, also reduce supply, but on a much smaller scale. But crucially, it's not going to boost demand, and it could even lead to contraction. So it's going to be vitally important to monitor the interplay between these various factors, as they're going to shape the direction of the market over the coming months. And Drewry will be your independent eye for these developments, and we'll stay on top of that and give our best and honest opinion of where things are heading. So risks to supply include not only that the handful of ships that are still stuck in the Gulf, they're effectively out of service for the duration, but there's also port congestion, slow steaming, potentially greater slow steaming if there is a need to reduce fuel consumption, which is something that we expect to intensify if bunker shortages manifest. But on the flip side, rising oil and bunker costs will also feed into inflation that's going to sap business and consumer spending power, thereby reducing the potential for container volume growth moving forward. The container team at Drewry, we use the same two scenarios that Rajesh outlined earlier. So short disruption to the end of June, and a prolonged one for a full 12 months till about February next year. And now under our base case assumption, a short disruption doesn't really result in any more than this temporary spike in freight rates that are driven by higher fuel surcharges, a modest dip in terms of global growth, in terms of volumes, and the familiar demonstration of supply chain resilience that we've already seen. But a prolonged disruption is going to be far more consequential. If we had a 1-year disruption to Hormuz that saw oil prices go up to as much as maybe $150 per barrel, that's going to deliver a very severe shock to the global economy, and it's going to embed fuel-driven cost inflation as the dominant driver of container freight rates. And it will also further inflame geopolitical tensions, which have become the major risk factor in container shipping, as we would anticipate that major powers will scramble to secure alternative supply routes and strategic reserves. So it's not a recipe for peace and harmony. Now, in the last edition of the Container Forecaster, which we published at the end of March, we downgraded our expectation for container port throughput growth for this year down to 1.8%, and that was down from 2.2 in our February update. Subscribers to the Container Forecaster receive monthly updates to our key forecast via on demand. So another one is pending in a couple of days. Any further escalation in the conflict is clearly going to force a bigger downgrade. Under our pessimistic case, longer disruption scenario, we think that global port throughput growth for this year could sink to between 0.5% and 1.3%. So, basically sort of at close to sort of flat level growth, not contraction potentially, but we certainly see that and this comes after a run of 2 years of very strong growth of +6% in the market. But for now, liner disruption remains manageable. Container volumes have not collapsed. Trade flows have bent rather than broken. But if the Middle East conflict, even if it stabilizes and Hormuz reopens within our base case timeline, we do think it's potentially going to have, some longer lasting changes, not just temporary disruption. So I think we're now potentially at the point, where what was supposed to be temporary reroutings will become a more permanent feature of network design. We've already seen after the attacks in the Red Sea that the shift of networks from being cost optimized towards becoming more risk managed and resilience focused. That's been a work in progress really ever since the pandemic, and it accelerated with the Houthi attacks, and we think it could potentially become even more entrenched now. And so prior to the start of the conflict, Drewry was expecting a phased return of Suez transits with full normalization by March 2027. But the conflict has delayed that return indefinitely. So that will have an impact on effective supply or capacity to the market. In terms of the psychology of this, I think more diversification of routes is going to require a greater willingness from cargo owners to accept longer journeys. So in turn, that will increase demand for ships and will reshape or will inform new build and demolition strategies. You could argue that carriers and ship owners have been planning or preparing for for a permanent disruption, as it were, by ordering record number of container ships over the past few years. And if the pessimistic scenario plays out, it could well be that the pace of new build contracting will stay very high for longer than we had anticipated. But when it comes to new build strategies, they will also need to factor in the potentially weaker demand prospects and or bunker shortages. And under those conditions, it's likely that ordering could even slow down, and we'll see carriers lean more heavily into their operational toolbox, such as blank sailings, slow steaming, and even vessel idling. We think they could all intensify if this crisis persists. But whatever the outcome, there is going to be a much greater need for greater investment in ports outside of Hormuz that will provide safer gateways into the Middle East, and to upgrade the region's overland infrastructure, particularly for the Gulf Cooperation Council to finally build the Saudi East-West land bridge railway. Now, more broadly, without a swift and peaceful resolution, the container market, in our view, is going to become even more volatile, with operations and pricing dictated by swings in war risk insurance and energy costs. So it's a pretty pessimistic outlook, but we still remain hopeful that a peaceful resolution will be found shortly. Okay, that's all from me. I'm now going to hand over back to James for Q&A.
Hey, Simon. Rajesh, thanks very much indeed for those updates. That's tremendous. I see we're actually at the 30-minute mark already for the session. So yeah, we are out of time, but I think it's only appropriate that we give 5 minutes to Q&A. So I'm going to dive straight in if I will. We actually had a couple of questions before the session, and that were pre-sent to us. So I'm going to start with those if I may. And the first one, Rajesh, it's a question for you. Will there be? It's a big one. Obviously, it's broad, and I think we've got a slide pre-prepared for this one as well. Do we see any significant structural changes in the oil and gas market, shipping market, as a result of the Iran war, and what form might those structural changes take? Perhaps you could just cover those very briefly.
Yes. So as far as the question is concerned for the long-term implications, obviously I'll break it down into three parts. One is supply, then demand, and trade patterns. So oil supply per se, any disruption during the war so far, I think that will come online within a year of time. Maybe whatever disruption to happen to refinery infrastructure. So effectively, a long-term impact on supply is not there. When it comes to demand, it depends. Like considering the current uncertainty, and world has like come to know that they are far dependent on the fossil fuels, and particularly one single blockade of one choke point has disrupted the global supply. So governments across the globe, they'll accelerate the push towards renewables. There might also be increase in investment for increasing the domestic production. At the same time, we can see a surge in EV fleet going forward. So all these will lead to like you can say faster peak in oil demand going forward. In terms of trade patterns, obviously if there is any gradual decline, or you can say early peak in oil demand, it will be negative for the tanker market. However, if there is any kind of permanent toll on Strait of Hormuz, in that case we can see a significant shift in trade patterns. Tolls like recently announced by Iran earlier, like it will be to the tune of $2 million for single transit. So for a VLCC carrying 2 million barrels of oil, it translates to around $2 per barrel. So that way it will increase the attractiveness of alternative supply, especially from the Latin America and US. And we can, going forward, we can see a surge, or not surge, an increase in shipment from the Atlantic basin to Asia, which will be positive for the tanker market. For the LNG market, again, apart from this midterm disruption to the Qatar LNG's infrastructure and 17% of the country's supply, supply itself is like will not be impacted in the long term. Again, the demand will be impacted in the long run if there is a acceleration in the demand for alternative fuel, renewables. So that obviously will slow down the expected growth in LNG demand and trade. Similar to oil, any permanent toll by Iran will again here make the US LNG attractive for Asian buyers. So far, there is like a very limited trade between US and Asia for LNG. But in case of toll, obviously, it will increase the attractiveness of US LNG. So we can expect long haul trade increasing going forward in such a scenario. Yeah, that's all from me, James.
Great. Thank you, Rajesh. I've got another question actually here, which is for you, I'm afraid. And it relates more to the long-term disruption picture. And the question is, and we've had a couple of people ask this question, I think it's probably something that a lot of people are watching, is there sufficient oil inventory globally to meet demand if disruption should last into that 12-month prolonged scenario?
Okay. So Yeah, it's an interesting question. Before the war, I used to, like, as an analyst, I used to think that any possible disruption of Strait of Hormuz that will turn into a debacle for the global oil supply as well as global economy. But now when I look at the net impact of around 10% of supply gap, and if we look at the IEA's global assessment of inventories, it's around onshore inventories are around 6 billion barrels, which effectively will come down to around 60 days of forward demand cover globally. So that way, if we take out, like, bank on inventories for this 10% deficit, obviously these inventories will last for 600 days. So on face of it, it looks like it's not a difficult situation. But again, these inventories are at select pockets. Some countries are entirely dependent on import for their consumption. So those countries will be impacted significantly. At the same time, like major inventory holders, or you can say major refiners, if they prioritize their domestic supply, in that case, there'll be shortage for other users. So in such a situation, obviously, there'll be surge in prices. In any case, uh, no matter what, even if it is 60 days of forward cover in inventories, once these inventories start depleting, oil prices will react like anything.
Interesting.
Yeah.
Yeah. Simon, I'm going to switch across to you. I've got just a couple of questions I think we've got time for. Again, a couple of people have been asking about normalization and when we envisage container trades returning to the Gulf. Question here from Neil Decker. When do you envisage global lines returning to direct Jebel Ali calls if a ceasefire and hostilities is negotiated?
Okay.
So what's our expectation on sort of some sort of normalization return? And again, there are a couple of questions on this subject.
Yeah, this is a very difficult one to answer, mainly because the two parties seem to be so far apart. But yeah, if we get a substantive and pretty rock solid agreement between the parties, that hostilities will be over and Hormuz is safe. That is the key thing. Once you get that, and there may be some delay in terms of having to clear any mines, sweep some mines out of there, but if we can get an agreement, we would anticipate that direct services to the Gulf would resume fairly quickly. But the key is when might that agreement be reached? So fingers crossed. Shortly, but if not, we don't. Carriers are going to be stuck in a wait and see mode, and they will wait, and they will continue to operate in the same fashion that they have. So that this is this sort of patchwork, multimodal solution for the Middle East. But yeah, there's no way the major carriers are going back into the Gulf. I mean, we've seen just over the last day or so, 3 MSC-linked ships have been, attacked. So it's not safe. Until it is, you can discount the idea of going back directly.
A broader question here. I think the last question, because we're now at 40 minutes, so I think we'll make this our last question. A comment on the outlook for container rates. I mean, this is, again, perhaps challenging, maybe not so. Rates have been fairly benign. So question here on, yeah, absolutely. So question here on the outlook for container rates as we look beyond Q2 towards the end of the year. What are the implications, therefore, for container line margins, given cost increases?
Yeah. So, yeah, as you alluded, outside of the Middle East, yes, there was a brief uptick. I mean, Drewry publishes a weekly index of 8 container routes, the World Container Index, and yes, that did pick up about $100 per week at the early point of the conflict. Last week and the week before, I think, don't hold me to that, but it's starting to plateau and even come down slightly. So it has been benign, as you put it, outside of the Middle East. The prices to serve the Middle East have skyrocketed. But if we discount that, if we localize that. So yes, the outlook for freight rates, we still anticipate that there will be a decrease from an average for 2025, and this is contract and spot rates. For 2026, there will be a decrease because there is still the underlying fundamentals of the market is that it is an oversupplied market. That has only been propped up over the last year or so by temporary disruptions. Now, this, as I say, has had that effect, but as you can see, it's pretty minimal. A lot will depend, obviously, if there's an escalation and oil prices do go up and up and up. That is what's driving any increase in freight rates. So it is a cost. Is the fuel element that is driving this, which in theory should not benefit carriers because BAFs are supposed to be sort of revenue neutral. Although historically we know that carriers don't always 100% recover all of their fuel costs. So I think ultimately it's going to depend on the duration. As I say, how much will the interplay between how far will demand fall, how high will the bunker prices go, and as I say, if we start and what the sort of tail effects will be on to supply. So will we see more port congestion? Will ships slow down even more than they are? Will there be more blank sailings? Will there be idling of ships even in a really sort of poor or weak demand environment? All of these will have a factor, but as things stand in our base case, short-term disruption, we anticipate that the overall trend for freight rates is going to continue pointing downwards.
Right. Excellent. Simon, Rajesh, thank you both very much indeed for sharing your insights today, and indeed for everyone taking the time to join us today. I can see there are dozens of questions that we still need to get through. We will answer those. We will provide those in the post-session follow-up email, and that will include the presentation materials and a link to today's recording as well. So we're well over time. Thank you very much for the hundreds of you that I can see are still on the call. But we'll look forward to welcoming you to our next market outlook briefing in the coming weeks, and we'll continue to monitor events, obviously, in the Middle East very closely indeed, as I'm sure will all of you. So with that, goodbye. Thank you very much indeed for joining, and have a great day. Thank you.
Thanks very much. Bye-bye.
Bye-bye.
Thanks. Thank you.